Hi everybody, welcome back to our discussion of inventory estimation methods. In our last video, we discussed the gross profit method. In this video, we will discuss the retail method. As the name implies, the retail inventory method is used by many retail companies, such as Target, Walmart, Sears Holding Corporation, JCPenney, and Macy's. Certain retailers, like auto dealers and jewelry stores, whose inventory consists of a few high-priced items, can economically use the specific identification method. However, high-volume retailers selling many different items at low unit prices find the retail method ideal. Its principal benefit is that a physical count of inventory is not required to estimate ending inventory and cost of goods sold. In its simplest form, the retail inventory method first estimates the amount of ending inventory at retail by subtracting sales at retail from goods available for sale at retail prices. Retail amounts refer to current selling prices. Ending inventory at retail is then multiplied by the current cost to retail percentage to estimate ending inventory at cost. The cost to retail percentage is found by dividing goods available for sale at cost by goods available for sale at current selling prices. This example is the same illustration as shown on page 469 of your textbook, illustration 9-5. You might want to open your book so you can see the facts of the example as we work through the illustration. Home improvement stores uses a periodic inventory system and the retail inventory method to estimate ending inventory and cost of goods sold. The data shown here are available from the company's records for the month of June. Beginning inventory at cost $60,000, at retail $100,000, plus net purchases equals goods available for sale at cost of $347,200 and at retail of $560,000. The company then calculates the cost to retail percentage by dividing goods available for sale at cost by goods available for sale at current selling prices. In this example, the cost to retail percentage is 62%. The next step is to calculate ending inventory at retail prices. Think about this for a minute. It's very logical. If $560,000 of goods are available for sale at retail prices, and the company sold $400,000 worth of inventory, obviously at retail selling prices, then inventory that was not sold is $160,000. So ending inventory at retail prices is $160,000. Then multiply ending inventory at retail prices times the 62% cost to retail percentage to estimate ending inventory at cost. And finally, $347,200 of goods available for sale at cost minus $99,200 of estimated inventory at cost equals $248,000 estimated cost of goods sold. The retail inventory method tends to provide a more accurate estimate than the gross profit method because it's based on the current relationship between cost and selling prices rather than the historical gross profit ratio. This is one reason why the retail inventory method is allowed for annual financial reporting purposes. Even though the retail method provides fairly accurate estimate, a physical count of inventory is performed at least once a year to verify accuracy and detect spoilage, theft, or other irregularities. In the simplified example we discussed in the previous slide, we implicitly assume that the selling prices of beginning inventory and of merchandise purchased during the accounting period did not change from date of acquisition to the end of the period. This frequently is an unrealistic assumption. Companies apply markups and markdowns to their inventory. Illustration 9-7 on page 470 of your textbook provides a nifty summary of terminology used in applying the retail method to more realistic inventory estimation situations. After the initial markup of inventory, but before it has been sold, companies sometimes increase the selling price further. This is referred to as an additional markup. Or reduce the selling price, mark it down, or mark down. For applying the retail inventory method, we need to track the movement in selling price until it is sold. The following terms are associated with changing retail prices of merchandise inventory. An initial markup is the original amount of markup from cost to selling price. An additional markup is an increase in selling price subsequent to the initial markup. A markup cancellation is the elimination of all or part of an additional markup. A markdown is a reduction in the selling price below the original selling price. And a markdown cancellation is an elimination of all or part of a markdown. To illustrate, assume that a product purchased for $6 is initially listed with a selling price of $10. That is, there is a $4 initial markup. If the selling price is subsequently increased to $12, the additional markup is $2. If the selling price is then subsequently decreased to $10.50, the markup cancellation is $1.50. A markup cancellation reduces an additional markup, but not below the original selling price. We refer to the net effect of the additional changes as the net markup. $2 minus $1.50 equals a 50-cent net markup in this example. The top illustration depicts these events. Now let's say that the selling price of the product purchased for $6 and initially marked up to $10 is reduced to $7. The markdown is $3. If the selling price is later increased to $8, the markdown cancellation is $1. A markdown cancellation reduces a markdown, but not above the original selling price. We refer to the net effect of the markdowns and markdown cancellations as the net markdown. $3 minus $1 equals a $2 net markdown in this example. The bottom illustration depicts this possibility. When applying the retail inventory method, net markups and net markdowns must be included in the determination of ending inventory at retail. Well, this video is getting a little long, so this is a good place to end. In our next video, we'll discuss how the retail inventory method can be used to approximate different cost flow assumptions. See you next time.